Hey, good morning, everybody, and welcome to this Tuesday, April 22nd, 2025 edition of Trading Places Live at earningsbeats.com. I'm Tom Boley, Chief Market Strategist here at Earnings Beats, and I'll be your host here for the next 30 minutes or so as we take a look at the market action. Another wild one on Wall Street yesterday, a lot of selling at the open. Saw selling throughout much of the day, but we did get a nice little bounce into the close. Always nice to see a little afternoon buying, and certainly some buyers came back in. Trim the losses. I know the NASDAQ was down close to 4% at one point, and it managed to come back and try to cut those losses in half. Didn't quite get there, but did cut the losses down quite a bit in the final hour. Same goes for the other major indices. And of course, we've been talking about the high volatility in the market, the S&P 500 in a very, very wide trading range right now. One of the largest trading ranges I can recall. But got the recent low down close to 4,800. We got the big breakdown that occurred at 5,521. That really hasn't changed, and that really has opened the door to a lot of these big swings that we've seen back and forth. So, yeah, it's just a matter of time. We've got to have some patience here to try and get the market back on its feet. Of course, there's a lot of folks waiting for another shoe to drop, and maybe it will. Again, watch that 4,800. That was a level that we set back at the end of 2021, early 2022, right before we went into that cyclical bear market. We broke out above that about a year later and really never looked back. So going back down, testing 4,800 technically makes sense. I certainly wasn't expecting that kind of drop when we began the year, but I was looking for at least 10%. I thought we were, poised for a move back down. We were trading near the upper end of the channel, that 15-year channel that we had been in on the S&P 500 since the financial crisis. And, now we've kind of gone back and not only tested support, but also within that channel, tested that middle line that I like to show on there, which happens during corrections and cyclical bear markets. So that much remains consistent with what we've seen in the past. And now it's just a matter of where we go from here. Does the other shoe drop to the extent where we break down and go below 4,800? If so, probably it's going to be a lot of volatility. We're going to see a VIX that's probably back up in the 50s again, maybe even 60s, 70s. And the problem with that kind of a market is the impulsive selling and the lack of market maker support creates massive drops in very short periods of time. And so it's very easy to see, another 10% lopped off the market in a matter of a couple of days, as opposed to, a 10% correction, which we saw in 2020. When was it? 2023, when we had the 10% correction, July through September, October. I mean, that was a 10% correction. It took a few months. When you get a high VIX, you can get a 10% drop in just a couple of days. And that's the scary part. There's just no one out there buying. So anyhow, let's take a look at yesterday's action and what happened there. So just pulling up here, I know at one point, I think the Dow was down, 1,400 points, something like that yesterday. You can see that shaved back down to 2.5%, just under 1,000 points. Still rough day. I mean, I'm not trying to sugarcoat things here. Definitely was a bad day, but we did see a lot of afternoon recovery, which was good. Here was the Dow. You can see coming back up. It looks like maybe it was a couple hundred points. So maybe we were down 1,200. Or excuse me, that was the NASDAQ up a couple hundred points. So yeah, we were down 600. We got about a third of it back, I would say, just quick eyeballing. S&P 500, you can see there was the gap down. Then we saw the selling. And then we bottomed around 2 o'clock. Tried to put in a double bottom around 3 o'clock. And then you can see in that final hour, cutting quite a bit off the losses. We had gotten down to 5,100, I think just a little bit below. And you can see coming back up in just the final hour, gaining more than 1%. That's normally a pretty good day. And, again, when you get the VIX, that's still up above 30. You can see it right down here. Right now, 33.82. So that was up 14% yesterday. I know at one point it went up over 35. I think I remembered seeing 35.60, 35.70. We did come back down and close 33.82, but still very elevated. As I've said before, you're not really out of a bear market, in my opinion. I don't think it's confirmed from a sentiment perspective until you see the VIX go back down below 16. And we got a long ways to go to get back to 16 still. So it could be a while, even if the market were to recover, it could still be a little while before we would get that confirmation. Let's see, what else do we have? Small caps, mid caps. Small caps on a relative basis outperforming again. We've been seeing that of late. So I'm kind of watching that, keeping an eye on that. I think it was probably about the fifth straight day or so. Actually, I'll go over to this other screen. Let me show you what I'm looking at there. So if we pull up the IWM versus the QQQ, and I'm going to put it on a 5-day, 10-minute chart. Actually, maybe we'll stretch that out to about 10 days. And let's use the line chart. Okay, so here, I mean, you can see the small caps relative to large caps through about April 11th, and then again last Monday on the 14th. Kind of, we were going down. Small caps were underperforming. And now you can see throughout this past week or so, maybe a little over a week, we've been seeing outperformance by the small caps. But still, in the long-term scheme of things, I mean, if we're talking about, looking at, the daily, and let's go back, I don't know, 6 months. That's when most of everything's taken place. Actually, no, let's go back a little bit further. Let's go back about 9 months. Because we had that big run up in July into August, and then we kind of, struggled, started to make another move late in the fourth quarter, kind of setting up the way I thought for a big advance in the small cap area of the market. And then, of course, as soon as we got word and we started getting signs and Wall Street started anticipating the fact that the Fed was no longer going to cut, you can see what happened to the small caps. It was very swift back to the downside relative to the QQQ and the Mag 7 stocks. Money shifted right back over, and we've been struggling since. And so I've gotten questions a lot from members, what do you think of the IWM? Are you still bullish? I just think right now it's on hold. I'm still bullish, but when the market environment does not favor small caps to just, continue to pile into not only the IWM, but occasionally the TNA leverage, doesn't make a whole lot of sense when we're seeing this kind of relative relationship. Even the recent recovery, it's nice. And on an intraday basis, it's even better. If you haven't looked at if you're a member of Earnings Beats, go back and look at that weekly market report that I wrote yesterday. That's where I highlight the intraday relative action between the IWM QQQ, between the XLY and the XLP, losing my train of thought here. One other one. The heck's my, QQQ and the spider. So the QQQ being the more aggressive one there. And so if you look at those intraday, they've actually started to show a lot of strength, which kind of follows suit and confirms some of the manipulation I've been talking about in the market, where we see, gap downs, and then we see recoveries where the market's getting a lot of points back and actually making, progress back to the upside during the day. And we're seeing that same thing on the intraday charts. So anyway, check that out. And if you're not a member, sign up. I mean, it's 30-day free trial. Get yourself through these next 30 days. Let me show you the things that we're talking about on a regular basis at Earnings Beats. I don't think there's anyone out there that's done a better job of calling the market. And I don't think it's happenstance. I don't think that it's just random occurrence. We do our homework. We do a lot of research. We do a lot of studying. I see what causes tops and bottoms in the market, and I apply it. And that's, how I come up with the calls that I make. They're not all right. I'm not trying to say that every single time I think the market's going up or down is right, because it's not, especially in the short term. From day to day, I wake up just like everybody else and look to see if futures are up or down. I have no idea what's going to happen. Sometimes, like yesterday, we had a nice finish into the close, and I thought, well, maybe we'll get a little bit of movement back to the upside. But that's about it. If we finish strong or we finish weak, sometimes that kind of leads to some earlier action. Let's see what the futures are doing. Actually, I'll just do that on this page right here. You can kind of follow along with me. Here's the diamonds. So right now it's 9:11 in the morning. So we got about 19 minutes to go before the market opens. And we got the Dow Jones Industrial Average up 1.1%. We got the Spider up about the same. We got the QQQ up 1.2%. IWM 1.2%. So across the board, getting back some of what we lost yesterday, which is good to see. I am seeing some breaking news that the IMF is slashing 2025 U.S. growth forecast to 1.8% from 2.7%, citing trade tensions. But you can see the market at this point not really paying any attention to that. And the other thing I think you have to consider is, and we talk about this all the time, the stock market prices in bad news and bad things. The stock market going down, when the S&P 500 went down 20%, lopped off 20% of the value of all the public companies, or at least all the public companies making up the S&P 500, that's kind of a big deal. It doesn't happen very often. That's only the 15th time it's happened since 1950. It's pricing in bad news, and that's the disconnect, I think, between some traders who maybe don't use perspective or don't, learn history. Many times the stock market's gone down long before we see an actual, we get the information that we're in a recession or that we had a recession. Sometimes the market's already gone back up close to all-time highs by the time we get that information. And so folks are getting the news and not understanding why the market's going back up. It's because it was already priced in to begin with. The market now is looking 6-9 months down the road. It's not looking at the same period that we are by following the news. We're way behind. And so that's the key when the market's going down, and why, sometimes people look at me like I'm crazy when I say I think, we're in a bottoming process, because you're focused on the news and all the things that are going on around you right now. The market's looking way down the road. Let's take a look. I want to bring up the S&P 500, and this is kind of rehashing the same things, but I never know. Get a lot of new folks watching the show, but I do think we are in a very wide range. Before I go into the daily chart and show you what I'm looking at, I want you to take a look at the weekly chart, because this is where I'm talking about that breakout from the 2021, early 2022 high right there, right before this cyclical bear market in 2022. You can see we were up at about 4,800. I think the intraday high on January 3rd or 4th was 48.19, something like that, 48.19 and change. Look at where we came down to. Came down to 48.35. Now, I did not see all of that coming. I did not call for a cyclical bear market. Like I said, I was calling for a correction, and it morphed into one. The first move down 10% took a little bit of time. You can see February 19th, I believe, was the high. And then we went down over the course of the next month or so, down to that 10% threshold. The second 10% came in about a week and a half, if that. Had a lot of selling intraday, but also mostly on the gaps. And that's where we can see, if we go back to that daily chart. See the big gap downs? And we also had red filled candles. So that's telling us those 2 days we had gap downs, but we also had selling on top of it. But since then, that's when I believe we've seen a lot of manipulation. Gap down, we went all the way to 4,800, but then we came back up and closed at 5,060 or so. The next day, moved back down, but we did finish off the lows. And then, of course, we had the big rally back. But as big as that rally back was, you still have to understand it was all within a trading range. It's just that we're not used to seeing 500, 600, 700 point trading ranges. But when you break down below support at 55.21, that creates your resistance at 55.21, and the price low down at 48.35, and then knowing that prior high was at 4,800, that becomes your support. So that's the 700 point range I'm talking about. And look at it. We literally in 2 days, we almost went from the bottom of the range back to the top of the range, but then we rolled back over. So technically, if I just look technically and I had no access to anything else, I would be as bearish as anyone else. I mean, we're, moving down. Each low has come with a lower PPO. PPO starting to roll over again. We keep failing at the 20-day rolling over. There's nothing on this chart telling me to be bullish. I mean, at a minimum, I'd probably say, hey, let's see if we can bounce off of a double bottom, probably heading back to 4,800. That's what I would say if I strictly looked at the price action. And we may still get it, even with some of the other signals I'm seeing. We still may go back and double bottom and see if we can hold there. That wouldn't surprise me at all because, again, it's part of our current trading range. Anything goes within a trading range as far as I'm concerned. But usually, we get a trading range where, you drop down maybe 100 points off the high. And so you're in that range for a little bit, maybe here like 58.75 to 6,020, 150 point range that we're in until we break out. And then we go down, we test this gap area. So we maybe lower the range a little bit back to 5,800 here. I think that number was 57.82. And then back up to 6,100. We established a new high, 61.44. So that became the range at that point until we lost the support level. And then the big thing with technical analysis is, and this is TA 101, broken support becomes resistance. And never could we see it much better than right here. Here we break below this low in this gap support. That's 57.82. We go down and we get a low of 55.21. There's our trading range. We started to bounce off 55.21. That's our low close. That's our support. 57.82 was our prior support, which now becomes resistance. And what do? We go right back up. We actually cleared the 20-day moving average. So somebody who's only following moving averages got whipsawed. But I like to use the combination of the moving average and price resistance. And if price resistance is above the moving average, you got to be careful if you get through the moving average. Make sure you get through price resistance as well. We didn't do that. Went right up, closed just below 57.82. I think intraday we got to 57.86. So we did, just breach that resistance level just briefly, but came right back down below it. And then the selling began again. We went back, tested the lower end of the support area, bounced back to the 20-day, and then we broke down. So we're still in this period of prices falling. So even though I've said, hey, I think we could be in a bottoming process here, that doesn't mean I'm not acknowledging that we're still downtrending. It's just that some of my signals, secondary signals, are telling me we could be putting in a potential bottom. And you don't get confirmation on that from a price perspective until you start reversing the downtrend. Well, at that point, I had a couple purchases down closer to 5,000. Recently, I think I filled out my position. I think the S&P was around 5,250 or 5,300. And so I've gotten back into the market down toward the bottom half of the trading range because of my secondary signals. And now I'm waiting, and the manipulation, which I'm not sure exactly where to put that, whether it's primary indicator or secondary indicator, but it's one I like to follow. But what I'm seeing maybe with some of the technicals is starting to line up with the sentiment is lining up with the manipulation that I'm seeing as well. So we'll continue to follow that trading range until it's no longer, until it either breaks down or breaks out. That's what we're waiting for. Technically, that's what I'm waiting for. And like I said, it's a 700-point range. So when you're in the bottom of the range, you're probably going to feel despair. When you're at the top of the range, you're going to feel tremendous relief. We went down from 6,100 to 4,800. That's 1,300 points. You gain 700 off the low, you're starting to feel pretty good. It's like a 50% retracement on Fibonacci. Let's see. I wanted to take a look at some relative strength and look at some areas of the market that are doing better. So if we pull this up in view all, these are my industry group relative charts. So it's all the industry groups relative to the S&P 500. So it's not the absolute chart. So if I show you like computer services here, you see this going up. This does not mean computer services is going up. In fact, you can see since February, computer services has been going down. But on a relative basis, the fact that we're turning back up here tells me that, yeah, it's going down, but it's not going down as bad as the S&P 500. So it's showing relative strength, even though it's showing absolute weakness. Hopefully everybody understands that. So one of the things I like to do is just continually track what's working from a relative basis, on a relative basis. Now I could go through and I could look at every chart like this, and go through the Dow Jones US computer services. Then we could jump down to semiconductors, and I could just do this and look at each one individually. Or nice feature is to go into this summary list at stock charts, and here it tells me what happened yesterday. But if I go to the time frame, I can hit this drop down menu and I can see, okay, what's happened over the last 3 months, which is basically since the middle part of January when I started getting cautious, maybe toward the end of January. And you can see gold mining and mining, top two areas. So if you're looking to trade momentum, if you kind of go by the old adage, there's always a bull market somewhere, then you're going to want to be trading gold mining and mining shares. That's been the best area of the market for the last 3 months. Tobacco, fixed line communications, water, mobile telecommunications, drug retailers, soft drinks, REITs, tires, food products, gas distribution. Something's missing. We don't see semiconductors. We don't see software. We don't see outside of the drug retailers. We don't see the retailers. We don't see internet. I mean, we're not seeing the groups that lead a secular bull market. Why? Because over the last 3 months, we've been going down. Those groups led the bull market, and they're getting hit, some of them getting hit pretty hard. And we can flip this and take a look at what's not working. Well, here's your automobiles. Think Tesla. Coming down, airlines, renewable energy, that's part of technology. Semiconductors, there you go. Down 18% relative to the S&P 500. Coming down, there's internet, down 10% relative. I was thinking software was down here. Maybe it's not quite as bad as I thought. There's banks continuing to watch. There's software. Actually, software last 3 months not doing as bad, but still down relative to the S&P 500. And so the groups that normally lead us are not leading right now. And those are the groups you need to keep an eye on when they start to move back to the upside. So let's take semiconductors, for instance. You can see on a relative basis, we're trading below the 20-week EMA. This is a 20-week relative EMA. Then you got the 50-week SMA, relatively speaking. We're below both of those. This is a bearish configuration. Whenever any chart is below its 20-day and the 20 days below the 50-day, and you're looking at a negative PPO, that is a bearish setup. So I don't care what you're seeing. I mean, you could be looking at other signals that are suggesting we're going to get a turn. Right now, semiconductors are one of the worst areas in the market. And, so you've got time. In other words, I mean, yeah, you might not catch the exact bottom, but when these stocks start to move back up and clear the 20, and then the 20 eventually comes up and we clear the 50, this goes positive. This is the type of chart where you want to be trading semiconductors. When the semiconductors are showing leadership, let them cross. This was back in 2002, early 2003, February of 2023 is when the configuration turned completely bullish. You had a lot of time to make a lot of money in semiconductors. So yeah, you didn't catch the exact bottom, but if you're patient, let these stocks recover, I think you'll have a better chance of trading success in those areas. Software. So software, over the past 3 months, I guess, yeah, because technically we were right about there. Now we're down a little bit, but we've been over the course of the last 15 months in a downtrend on software relative to the S&P 500. We've got to see this change. Look at how long the PPO has been below zero. We had one little minor head fake, but otherwise there's been no reason from a relative standpoint, there's been no reason to be in software. Now, I know, for instance, I've expected software to perform better from time to time, I've started seeing things on the individual absolute chart. But from a relative basis, we've never had strength last long enough to really trigger a meaningful buy signal. But when it does, again, take a look at how quickly this group, how quickly it leads, how fast it outperforms. That's when you want to be overweight software, semiconductors, and so forth. Give them time. We did our model ETF portfolio last night, and I got a little aggressive because I don't believe that we're going to continue to go lower. Personally, it's just I'm basing it on history. I'm basing it on perspective. I'm basing it on many of my secondary signals, the sentiment, a number of things that I just don't believe the market's going to continue going lower. I just don't think it's set up to go lower. I think there's a bigger risk of being in cash than being in the market right now. So I got a little bit aggressive, and I'm kind of anticipating some moves to the upside. But you don't have to do that. You can certainly wait to see that. And if the market keeps going down, it'll help you avoid those mistakes. That could be a mistake that I'm making. I'm just being honest. I believe that the stock market's going to turn back around. I think we'll stabilize. I don't know that we're going right back up to 6,100. I don't think that's going to be the case. I do think we have some issues to get through, but I think the sentiment has become so bearish. I just don't know that there's a whole lot more selling out there to go. And so that's why I'm turning a little bit more bullish, especially when I start thinking about 3 months out. Not so much today or tomorrow. I don't know which way the market's going to go. Again, I think we're in this process. But if I think 3 months from now and you tell me you have to either buy the S&P 500, sit in cash, or short the S&P 500, at this point in time, I would buy. Not knowing anything and knowing that I had to keep that same position for 3 months, my choice would be to buy. Again, I think a lot of bad stuff's being priced into this market. I don't know if it all hits. If it all hits, maybe we go down a little bit further. But if it doesn't hit, if it doesn't stick, if we don't get the inflation, if the tariffs don't send inflation surging, or if there's a deal struck on tariffs, I think this market's going to be a lot higher than it is right now. And so I think a lot of folks, when bad news is hitting, can only think about the worst case scenario. I think there's a best case scenario out there too, and it looks a whole lot better than what a lot of people think. So got to keep it all in perspective. I think that's really important. So the last thing, we got a couple minutes here before the market opens. So the last thing I would do is take that strength, go to, I'll show you a couple of different ways you can do this. Go to the scooter reports, and this will come up default large cap stocks. And it's in order of the highest scooter scores, which is Stock Chart's technical rank developed by John Murphy. It's a form of relative strength. It's not the same as pairing a stock against the S&P 500. It kind of is, but it isn't the same. The thing I would say is different when you're looking at the scooter. One limitation is that it's only looking at the last 5 months, and it's not looking at the stocks relative to the S&P. It's looking at the stocks relative to its own asset class. So it's large caps versus large caps, mid caps versus mid caps, ETFs versus ETFs. That's how you have to look at the scooter. But anyhow, if you're looking at this, you still see which stocks are leading. Look at the gold mining stocks that have all climbed up the list, 5 of the top 8. If you're looking to trade momentum on the long side, look no further. Those are stocks that you could absolutely trade. I have only said in the past, I'd wait for pullbacks. I'd keep my stops tight. I don't believe in these stocks long-term. Everything is in their favor right now. High volatility, gold stocks tend to do. Gold does very well with high volatility. It outperforms the S&P 500 when you get high volatility and when you get a falling dollar. And we've got a dollar that's been going straight down, and we got volatility that's been going straight up. Perfect environment for gold, and gold is thriving right now. If those two factors reverse, gold will be right back out of favor. And I think it's going to happen. I just don't know when. So stick with the trend. I have no problem with gold. Longer term, I have a problem, which is why I would make sure that I get it in on pullbacks. I don't chase, and also want to make sure wherever I get in that I keep a fairly tight stop. I don't want it to get away from me. I don't want to take a big loss when the market starts to rotate elsewhere. But I mean, you can do that at every level. Mid caps, if you want to get maybe a little more aggressive, looking at the mid caps, there's a gold mining stock right there, Harmony, 99.1 scooter. And then small caps, there's gold mining right there. Stock 219,000 traded. We could pull that up. It is 9:31, so the market's open. $3 stock. Some of you might love these small stocks. This thing's in a very nice pattern. Consolidated for a while between 2 and 250. Broke out of that. Look at the volume coming in. It has pulled back a little bit. I prefer it on the 20-day moving average. You know, if you like small cap stocks and you like gold, I'd like to get a little bit lower just so I can kind of manage my risk. But even where it is, $3 is better than where it was, which was up near, what, 375 or so. So these stocks will pull back, and that's what I would use to jump in if you're interested. But, you know, this looked like semiconductors a year ago. You know, this is the area of the market that's moving up, and we need to wait and have patience on those other areas. Now, I happen to believe some of those other areas are creating tremendous value if I'm right about the market going back up. So I've taken a position in some of the large cap Mag 7 names, even though their charts don't look great. That's a decision I've made, and I know that it's risky. When you're in downtrends, they can go down further. But I've got stops in play that I'll be, you know, using if I need to. But I'm going to give them a little bit of room because we are in this wide range, and you know, anyway, go from there. But let's take a look at the market and wrap this thing up. We are off to a pretty good start. You can see green across the board. The VIX down 6%, back down to 31.5. Still a long way to go on the VIX, though, again, to confirm that the worst is behind us. The Dow, though, up 411. It was down 900 yesterday. So, again, perspective. Today's great. It's half of what we lost yesterday, so we still got a lot of work to do. We're still in this wide trading range on the S&P 500. Yes, we're up 1%. That's a pretty good day anytime. But we could be down 4% before this day's over, or we could be up 4%. I don't know where we're going. Again, we've got a tremendously wide trading range. And I'd like to be able to say that, hey, I know this is going to go back up to 5,400 before it goes to 5,000, but I don't know that. I mean, we can look to seasonality. This is not a bad time for the market as we go toward the end of April and into early May. So maybe we use that to make our way back up to 55.21, but sentiment's not a guarantee. So we'll just kind of follow this and we'll see how we do. Anyhow, that's it for me. I want to mention to members. Well, actually, first I want to mention, like the video. That helps us with the YouTube algorithms. Like the video, subscribe to our channel. That helps us. I know we look at the market a little bit different than many technicians. I think it's a good thing. I think it's a unique perspective that maybe, you know, is based off of a lot of the research that we've done over many, many years. I think that we've had a tendency to get it right more often than get it wrong. But anyway, if you like what we do, subscribe to our channel. That helps us. Subscribe to our channel. Turn your notifications on. We do live streaming events from time to time. If your notifications are on, you're going to get a notification from YouTube that, hey, Earnings Beats is starting a live show. You click right on it and you join in. It's simple as that. If you don't have those notifications on, you're probably going to miss some stuff that we do. Anyhow, the other thing I wanted to mention, at 10 o'clock this morning, coming up in 25 minutes, we're going to have an abbreviated live trading room. I cannot do the Wednesday one tomorrow. I've got a commitment, but I didn't want to miss out. I've had a kind of a rough schedule the last 6-7 weeks. So I didn't want to miss out on another Wednesday trading room. So we're moving it. We're going to have it this morning, probably do it for 45 minutes or an hour. So come on in. If you're not a member, go to Earnings Beats right here. Start your no-cost trial, 30 days. You do have to give a credit card. We'll remind you before your credit card is hit. I promise you, we're not going to just charge you and hope you forget about it. If you're not comfortable, if you don't see value in our service, thanks for trying. That's my approach. That's our approach. We do know that there are a lot of folks that we do appeal to. So you won't know unless you try us out. 30-day trial there. Come into our live trading room in 25 minutes. And for the next month, you'll have a free trial. That'll be 5 live trading rooms in addition to everything else we do every Wednesday at 10 o'clock. And they normally go on, I hate to say this because I don't really want to do it for 2 hours, but in the past, they've been going on for about 2 hours from 10 to 12. And it's not just all about trading individual stocks, buy this, sell that. It's about trading philosophies and strategies. It's about, how to find solid candidates. It's about where to set stops. There's a lot of good technical trading analysis and tools and so forth, strategies that you'll be equipped with. But anyway, check that out. Or if you just want to follow us a little bit closer, we have a free newsletter. I mean, tens of thousands of folks have joined our free newsletter. Earnings Beats Digest comes out Monday, Wednesday morning. Try to get it out early before the market opens. If it's not out early, it's my fault. You can blame me. I don't always get it to Erin, who sends out our EB Digest twice a week. So if it doesn't go out, it's usually because I haven't given her the information yet. But anyway, name and email address, all that takes, no credit card. We don't sell your information. You're not going to get spammed by third parties. You might get spammed by us because that's how, got to stay in business somehow. Got to get folks who are willing to pay us. So I'll just be honest about that. But we don't sell your email address, so you won't have to deal with a lot of other websites as a result of subscribing to our free newsletter. All right, that's it. Anyway, have a great day, everybody. Appreciate you tuning in, and I'll be back next Tuesday for Trading Places Live again. Just follow us in all of our various shows and join us and come into the trading room in 20, 25 minutes. Hopefully, I'll see you there. Happy trading, everybody.